we will cover what is a stock exchange and the terminologies related to a stock exchange. A stock exchange is an organization with a physical location that hosts a market where securities of listed companies are traded between buyers and sellers. Examples of stock exchanges are BSE, NSE, NYSE, NASDAQ, Tokyo Stock Exchange, etc. Let's proceed to look at a few terminologies associated with the stock market. Ask, or offer price, is the lowest price at which a seller is willing to sell the stock. Bid price, this is the highest price that a buyer is willing to pay for a stock. Ticker symbol, it is a unique combination of letters that represent a particular stock listed on an exchange. Since the symbol refers to a specific stock, it is easy for investors to buy or sell a particular stock on the exchange. A company may have several ticker symbols, depending on the trading platform. ISIN, International Securities Identification Number, is a 12-digit code that uniquely identifies financial instruments, like stocks, bonds, derivatives, indices, etc. The first 2 digits are the country code, in which the issuing company is headquartered. The next 9 alphanumeric characters refer to the national securities identifying number assigned by each country. The final character acts as a security check. It is a universally recognized code, primarily used for clearing and settlement of trades, and to track institutional investors' holdings across markets worldwide. Price to earnings ratio. The PE ratio is the ratio of a company's share price to the company's earnings per share. Investors use to derive the value of a company. It is calculated by dividing the market price of a share by the earnings per share. Primary market and IPO. An IPO, or initial public offering, is when a company that is not listed on the stock exchange decides to raise funds through the sale of securities or shares to the public for the first time. It is done in the primary market. Since securities are sold for the first time here, a primary market is also known as the new issue market. Secondary market. Once the company is listed on the stock exchange, its securities can be traded among investors. This aftermarket is called the secondary market. Insider trading involves the trading of securities based on information that is not known to the public, where the outsider could potentially make larger profits as compared to other investors, basis the insider or confidential information received. There are 2 types of insider trading. The first type occurs when people inside a company trade the stock of their company based on material, non-public information. Example, Peter is employed by Company A and trades its stock, basis confidential information he has access to. The other type of insider trading is when an insider shares material information that is not public knowledge with someone else who will use that information to profit from it. Example, Peter sells shares, the confidential information of Company A, with Paul, who further uses that information to trade and gain profit. Market capitalization is the market value of a company's outstanding shares and is used to determine a company's size. Let's understand this through an example. If NR Industries Limited has 1 million shares, currently trading at $50 each, in the stock market, the market capitalization of that company would be $50 million. Based on the market capitalization, a company is categorized as large cap, mid cap, and small cap. For example, in India, a large cap refers to companies with a market capitalization of above 200 billion rupees. Mid cap refers to companies with a market capitalization of 50 billion rupees to 200 billion rupees. And small cap refers to companies with a relatively small market capitalization of less than 50 billion rupees. A market trend is a perceived direction of a financial market to move in a particular direction over time. The terms bull market and bear market describe upward and downward market trends respectively, and can be used to describe either the market as a whole or specific sectors and securities. Bull market. A bull market occurs when investment prices are increasing for a sustained period and the market sentiment is positive. It is the time when share prices are rising because the economy is doing well. Investors are confident that share prices will rise, and therefore they tend to buy more shares. Such investors are called bulls. Bear market. A bear market, on the other hand, occurs when investment prices are declining for a sustained period and the market sentiment is low or negative. A bear market is characterized by selling, as the economy is not doing very well. The investors are pessimistic and tend to sell their shares rather than buy new ones, and thus are called bears. Short selling is a popular bear market strategy. Let's understand short selling through an example. John, short seller, believes that the share price of NR Industries, which is at $500, is overvalued and will fall in the coming months. John, however, does not own any shares of NR Industries, but wants to profit from the situation. Therefore, he decides to borrow 10 shares from his broker for a small fee of $100. He then sells those 10 shares at the current price for a total of $5,000. His analysis is correct, and, after a week, the share price of NR Industries drops to $400. John then purchases 10 shares for a total amount of $4,000 from the market and returns it to the broker to complete the transaction. Here, John gets a profit of $900, which is the difference between the selling price and buying price minus the fees to the broker. Therefore, short selling refers to the selling of a security that the seller does not own. Short sellers believe that the share price of a particular company will fall. So they sell the stock at a higher price today and buy the stock later at a lower price when prices fall. With this, we have completed the definition of a stock exchange